everybody for coming. Remember, we do this every Wednesday night at 6 p.m. Central. Please invite a friend. We love sharing and talking. So this is basically a continuation of our Blood in the Streets, and we're going to talk tonight about government, friend or foe. So it's going to be an interesting topic. Again, you got to get your seatbelts ready for a little bit. So who Massive Capital is, partnering opportunities. We're going to talk about the topic, talk a little bit about our strategy, and always the best part at the end is the Q&A, because that's when you really learn, right? When you ask specific questions and you get some things other than the big brain dump that we do. You can also use the chat for putting any questions in, and we'll try to make sure that we get them happening and everything going. So let's get going. So disclaimer, we are not financial advisors. We are not selling you anything tonight. We are not lawyers, accountants, tax advisors, 401k specialists. So we're telling you what we think is going to happen. So this is what, to make sure you understand that. And then I believe now, Maria, you're going to do this. Look at her change her screen. She's ready for this big announcement.
I've been waiting for this all day. Yesterday, we got to announce one of our newest things, which is a new rebranding from Massive Capital Girl Society to She. There's no more the Girl Society, because we are a tribe of women, and we are here to talk about all of the things that we are growing together. And it's called She because she builds, she owns, and she invests. So she is me and she is you. So it's really exciting. And I hope that you guys are wanting to join our journey with us. So this QR code is to get the link for our calls. It's every first and third Tuesday of every month. So I hope you can make it, because we have some really powerful women coming to speak in the next few weeks, and we hope you can join.
And I got to tell you, it's the most amazing group of ladies that we work with. I was up in Dallas for the beginning of their book launch. Okay, so Powerful Women in Real Estate. It was absolutely humbling to be in a room with so many rock stars. It was really, even Sanjay, who comes to events, says hello, kisses a few people, babies, shakes hands, and leaves. He stayed till 11 o'clock and had the time of his life. So it was a really great event, and then they all stayed. #1 best-selling book. So I managed to get a few autographs. I didn't get them all, but it was amazing, and we're blessed. So thank you.
I love exciting. This is awesome. I mean, fantastic work. I mean, the whole She thing, it's so good. I'm in love with it the moment I saw it. I almost made a mistake when Jasmine sent it and I sent the logo to me. I was this close to publish on LinkedIn, but I was like, good Lord, I didn't do it.
She would have got you.
And
it's really amazing. It's not just us, it's all of us together. So we're excited about it.
I mean,
I guess I'll go back.
I mean, she's me. That's such a powerful statement when I can think about it. This is so cool though. I showed it to my wife. She was like, yeah, that's me. She is me. I was like, okay, I got it.
Exactly.
Awesome. So this is a slide with lots of information on it, but it basically just talks about all of the areas that Massive Capital is involved with. And it introduces a little bit of our connection with Realty One partners. So we do everything from land banking, land packaging, land development. So those are all basically just different levels of how you use and develop dirt. And then obviously building construction is when you're going vertical. Building operations is operating the businesses, the multifamilies, the different things we have. Building renovation, that's when you're doing the forced depreciation and doing everything. And then we're going to be doing some building and post repositioning. So we're connecting up with Realty One. You're going to see some more information. So here's a little bit about it. They have about 71,000 square feet of retail, about 252,000 square feet on retail center. They have a lot of square footage. They have about $290 million in assets. And then, of course, Massive Capital. We own about $145 million in assets. but this just kind of gives you the numbers. And when you see us being combined, it's going to make us a really good force to be reckoned with in the future. So here is all of the existing assets that Mark Massive Capital has. So if you look at the bottom, those are existing that closed last year, $141 million. And by the way, I went for the first time to our McCallum property. And it was a deal that they did before I joined Massive Capital. And I got to tell you, I saw before pictures, and now I saw after in person. Huge. I am super excited. It's going to turn out to be an awesome investment. They have really outdone themselves on fixing that up. Then so far this year, we've closed a land development acquisition deal in Georgetown. We just closed Amberwood Apartments, which we also turned, and we're just starting now to implement our plan. We closed on a value add 506B deal in Georgia. We're closed now on X-Space. Basically, we have one investor to fund that should come. If it hasn't come today, it'll be here tomorrow. And then we have a couple of secrets coming up, 506B. So we're always careful what we say. But for those of us that have a relationship with us, you're going to see that a couple of these are in the retail space. And then we have another possible Cottonwood, pardon me. We're going to do a shameless plug on Cottonwood. Got the order messed up a little bit there. So one of the things we want to show you, just to blow your mind, is the combined team. So this is blowing my mind. I'm here. So at the top, we have a lot of people from the investor relations team with myself. And then we have marketing, chief of staff, legal counsel, director of finance. And then we have a couple of rows here where we're in the accounting and asset management. Includes a mixture of Massive and Realty ones. And then across the bottom, we have in the middle there, we have everybody to do with acquisitions. And then across the bottom is everything to do with finance, building, construction. So again, part of the reason to show this slide is just to get you excited about what's coming and the opportunities that we're going to be able to give out to our investors is going to be staggering. All right, get your seatbelts on. Oh, sorry, my shameless plug. I have to have one shameless plug every deal. And tonight we actually have two. The one at the end, but the one at the end is, so our Cottonwood Apartments in Denver. We have a couple of spots still open. And we have done something unique. So this is a 506C deal, but for new investors that have not invested for Massive Capital, we decided we would try a 25K minimum. So if that's something that's interesting to you, you're an accredited investor, reach out. There's only a couple of those spots left, but we wanted to try it at the end of this particular raise, just so that we could give some people an opportunity to get in. I'm going to call it the starter kit, get to know Massive Capital, put some money into a deal, and it's a great deal. So hopefully you'll be interested and reach out to us. All right. Next shameless plug. Get ready. Get ready. So we have our virtual multifamily conference. It's going to be next week on August 11th and 12th. It starts at 8 a.m. So you got to get up early, especially if you're on the West Coast. That's 6 o'clock. Get your coffee ready. And it's 2 days of speakers, networking, and it's free. Think about that. It's free. So we do have a VIP special. We hope to have our code ready. So if you want to get a VIP ticket and you're an insider and you know somebody at Massive Capital, we should have that code tomorrow. Reach out to us and we can get you a code that will get that for half price. Again, it's going to be a great experience. And the VIP just gives you some extras and copies of recordings. So it's going to be great. It's our first virtual conference. We're super excited. Got a great lineup. Team has worked super hard on it. So I'm very excited. And, oh man, I got 3 shameless plugs. Now I'm really starting to go. So for those of you that don't know, I love investing with my retirement funds. And I'm speaking at a Quest event. So if you follow Massive, we're going to post it on our Facebook group or whatever. But you can sign up, and I'm going to be doing the power of passive investing through your retirement syndications. It's this Saturday at noon. It's an online event, but it's also recorded. So if you sign up and you can't make it, We'll send the recording. And again, if you miss all of that, you want the recording, reach out to me. All right, now get your seatbelts on. Sorry, 3 shameless plugs. I should be ashamed of myself. So, but they're all really good things. So, all right, you ready, Shar?
I'm ready. I'm taking it from here. On that note, we are active in the market. We engage with other investors, and we spend time with them. And once you're thick of it, you get to see how some of us think and how some of the larger players are thinking, how the funds and the equity and the debt markets are thinking, and then we kind of share our position based on what we hear now. And again, if you have been following us, you'll see every 3, 4, 5 months or so, we change our direction based on the market, right? So we start with the hypothesis, we execute on it, and based on the market signal, we optimize as we can go. So it's gonna be fun. Again, this is my tagline today: government is the enemy until you need a friend. So I always keep that in mind. They're the bigger hammer. So let's kind of go with it. All right. The first thing, our series is the government is the friend or enemy, right? And we'll talk through some of the stuff that we've heard and we know or it's coming. Then we'll try to play on the both sides of it. All right. So this was published about a week ago. CBRE cuts profit by almost 60%. As you know, we look at the profit earnings outlook for all the brokerage company because they are a good leading indicator and a lagging indicator how the market's going to behave. They're a lagging indicator of the performance of the market or the transaction and also the investor sentiment. And their head count, it's also a leading indicator which way they're thinking, right? Imagine CBRE runs all the data. So we track lenders, especially CMBS lenders, their head count. We've been tracking them. We track a bunch of other companies as well as a proxy, but CBRE, we like it. That's because they give you a transactional history and the investor sentiment. Second one is the Fannie Mae. They came out, I think, on the 19th by saying that they're expecting a recession on Q3 this year and Q1 next year. They're expecting a soft landing on some sector, hard landing on some sector. Hard landing potentially will be in real estate. So those are some of the news that we know. You have heard it, you see it all over the place. If I put them together, on the left side, you can see the 4 things that from the real estate perspective, profits are being cut, prices are being set, recession is there. That means some way, shape, or form, some categories of the some industry, they are going to get impacted. Bank reserves after the Silicon Valley Bank failure, Feds are asking or giving a direction. In one side, they're saying, "Hey, increase your cash reserve." That is not impacting a typical account owner or retail banking, but it is impacting the lending side, especially when us, the sponsors, are taking loan. When we started this year, lending was tightening up. In the middle of the year, it was the recourse part was pretty dominant. So a lot of the cases where we could get a non-recourse loan last year, that went away middle of this year. We take recourse loan as well. That's because some of the deal, all the deals that we do, we like them to the point we put our balance sheets in the fire. Most of the syndicating team, they don't, but we are comfortable with it. Now what we're seeing is that on top of a non-recourse loan becoming recourse, on top of that, they're asking for additional deposit. So let's think about it. It was let's say $10 million deal. Last year, we take a loan for $7.5 million. We put down $2.5 million. Same projects today, or about 3-4 months ago, would have been $6.5 million debt, $3.5 million on equity. And now it's $6 million debt, $4 million equity. And on top of that, we have to go put down $700,000 in a checking account in a bank. So we are going through this now. So it is tightening up quite heavily. Last one is the depreciation. Everybody who's paying taxes now, pay attention to that line. The depreciation was 100% last year, went down to 80% this year, going down to 60% next year. So synthetic loss is going down. So put together, we're in a top spot, right? But it's a top spot, and we have to play the game. So we are going to take a look at it, how to kind of position ourselves to make sure we get the max out of it, right? And then the question is why Feds are going crazy. What's the storyline? And our position is that everything that everybody are doing, there's a reason for it. Chances are this kind of a scenario has happened before. So if you could understand that, we could come up with a plan as we navigate through this downturn for next year and a half or so. That will boil down to a little bit more historical context. I plotted the data from St. Louis Fed. I love these guys. So as you can see, the top one, the brown one is the 30-year fixed rate. And then I plotted the price index minus the food and energy. I took the energy and food out. That has a non-US impact to it. So I kind of plotted it out. They track. So there are 2 coins, 2 segments of information I'll share. One was in the 1980s and 85. So when Feds come out, when Powell comes out and talks about it, this is what he refers to most of the time. Some of the learning, some of the mistakes that Feds made back then, that is cascading into today's one, is that they tightened up the monetary policy really, really quick, and they were reactive. They tightened up, they loosened up. They tightened up, they loosened up, and that 2 push back to back took the economy in a very rough spot. That's why the time it took to come back out, it was wide enough. Second one is they did not take a look at the structural issues, job supply chain, anything like that. They just pushed it. Back then, I believe that was the first one after the Great Recession. So again, no. And also, back in the days, economy was very isolated. It wasn't as global, and the global economic concept wasn't there. So they just did it without communicating with the financial market and things like that. As you can see here, if you step back and take a look at some of the news that kind of happened, and people are talking about it, what Powell said all the time. So they went tightening the monetary policy, but they did it really, really quick. So there's a concept in the corporate world. If we have to give a bad news, we go quick, we drop the bad news, we come back tomorrow and we forget about it, right? So I believe they did that version of it. So they did it tight and they did it quick. Probably that messed up the speed, right? Again, they tried their best, right? And the second one, they kept, one of the good things that they have done, they kept the internal supply chain and job is in forefront of all the conversations. You have Hart Powell says over and over that we are going after the inflation. We have reduced the price for the commodities based on the supply chain, but now they're after job, and that's what they're after. And they're very clear about it. We may not believe what they say. We may think, whatever they're saying is right. It's the different, because we want the market to turn, but Powell is saying and he's doing very clearly. So he's one of those guys. If he says he's going to do it, he's doing it. So that's the fact. Now, if you put them together on the left-hand side, the price and the recession and the bank reserves and Feds are saying, what they're going to do, and they're doing what they said they are going to do, right? If you put them all together, what's happening? And yes, we are getting a big down by the market, which is true. Lending are tough, which is true. But if you step back and take a look what Feds are doing, they're really calibrating the market, at least for the next decade. One of the things that we see, they're doing house cleaning or zombie assets. Sometimes we have had so many assets that we know assets are not performing, but the market came and pushed the price up. All of a sudden, that asset becomes a great asset. The operator becomes a great operator because they gave you 20-30% return, where asset itself was bad. One of the best things that's happening now, we are identifying the zombie assets, pricing being reset, and we know what the clear pictures are. Case in point, Class B and a Class C, the spread between those two was very tiny, it was narrowing up. But by design, they should have a wider price difference. Now we're seeing the price widening that's happening. So houses being cleaned out, other ones, reduction of the competition. 3 years ago, someone has a heartbeat and they can go raise money and they'll borrow the balances, they'll get the money and they'll syndicate. That was extremely competitive nature on the market. So we felt that the natural barrier to entry was low. And then everybody came in, and you have seen that in Russia, folks who wants to be a syndicator and got into the deal. That's one. Now true nature showed up. You got to have a really strong balance sheet. We got to have a liquidity, and we got to have a team to buy assets. Just going back to the example that I explained, in a $10 million deal, getting somebody to sign up. If you bring somebody else in who we don't know to sign a non-recourse loan, it's not going to happen. for the same team, yeah, they may raise $2.5 million, but chances are they're not going to have $700,000 or $500,000 outside the project to bring it back to the bank to do this deal done. All of a sudden, competition is good now. It's going down, which is healthy. And the last one is the available property in the market. When market downturn happens, two things will happen. The zombie assets will come back, and or people will exit with the asset that is the crown jewel of it, because crown jewel will sell at a decent price. So we like it because right now is the spot where most of the asset will come in. Either they fall into the number one category or it's a core plus asset. So all in all, yes, on one side, massive capital has an asset. We are going through our fair share of it. We're going to survive to it. But at the same time, we're taking one side of the chain, but the other side, we're happy because it is calibrating the market. So that's a good thing. That's a healthy thing. Because when inflation happens, when extra money gets pushed into the economy, when we do not know what to do with the money, when the money comes in, we act a certain way. That's what happened post-COVID. And now that has to go through the system and take it out, and this is what's happening. So when we look at it and say, okay, what is the positioning is? Our position is that this is the time to buy, and this is the time to gain market share, and this is the time to build a team. So going back to it, I'm going to share those slides again. The CoStar, the CBRE is cutting profit on one side, but take a look at this. The same guys are doing billion orders. Same thing, the Fannie Mae is coming out saying that industry is hurting, we're going to recession, but new construction are still there. So one side is, yes, we're taking a fair share of it. On the other side is everybody's looking a little bit further out and positioning themselves. So when it turns 2.5 years down the way, 2 years down the way, we're in a better place. The same philosophy that we have, and this is our strategy, we mentioned a couple of times. Again, what we believe as of now, we should avoid or pause any deal that has low interest rate. Any existing assets, larger 400 plus units, takes a lot of time. Multifamily buyers should not be in a pro forma. Office, the GP team must have some technical skills, others don't. Same thing with the land development, right? If the technical development skill isn't there, we should not do a deal like that. And also what we're seeing is that people or the syndicating teams or sponsor teams, stronger balance sheets, stronger technical skills, lots of equity and lots of liquidity are winning right now. They're getting deals done in this tough market. When I say tough, it is tough. It is tough. I'll share some more examples as you go. And our basket strategy has been asset with the price reset. Price reset means that asset and the market rates debt. We like to pay as high of interest rate as we can. And also we like to buy assets that is exposed to the market right now because market is almost to the worst. There is not that much. It's going to go down, maybe another 25 basis points increase coming up next month. Then it should plateau out. Second thing is technical skill. We are staying where we already own assets. We're not venturing out anywhere else. Year and a half ago, yes, we would have ventured out to a tertiary market. Not anymore. We're staying in the core plus locations, especially where we own assets. We are buying as many as you can next to it. We love new construction. We added the mix to it. This is where Realty One and Massive are coming together as one new team. So anything with the retail and the mixed use, it's going to make us, if we can survive and take the deal down now. Land is the same way. Land price goes up at the very tail end of it and comes down when the lending gets tight. It happened already. So land price got pretty good, quick price reset already. So now we're also doing bolt-on acquisition on land wherever we have assets. We're also buying multifamily value add in core markets where we feel extremely comfortable. We have an LOI, I believe, getting accepted in San Antonio for 100 plus units. We'll find out the more news later down the way. That same project has came back to us at least 4 times. We started Q4 last year. We looked at the property. We heard the price a little bit lower than what seller was asking. Seller says no. Came back in Q1, asked us to rebid. We rebid it. We were lower than the initial offer. The market is turning on us. Seller says no, too low. So seller was every single time they came back to the market turned on them, and we turned with the market, and there was a gap. But what happened in the last 6 months, 7 months, the gap has come to a point where an agreement. The seller understood that, hey, if you want to trade, let's not push it too high because market is not going anywhere. It's going to stay wherever it is for a little bit. So we are there. And we're also looking at distressed, extremely distressed offers with the seller carry. So we have a couple of two offices close to LOI, and we're shopping for the debt. It is interesting when we say market change, the same set of, we have a strong balance sheet, strong liquidity, good equity position. When we go banks, we have a strong relationship, right? But the same banks, we said we're going to give you a full recourse debt on a bank at ABC size. They're coming back and say no more banks. Sorry, no more offices. It doesn't matter what it is. It's not. It's a pretty interesting when you get into it. But we are bullish on office space because we're seeing buying price at the $45 a square foot at the 1990s in Houston area, which is roughly 1/4 of the replacement cost. So the whole point is if someone can buy and survive for next 2.5 years, you should be in the money after that. That was a lot of data dumped, and I went rather quick. So Trevor, back to you, big guy. So
Did you put your seatbelts on? I warned you. So it's a lot of info. So do you want to go to Q&A? I can't remember which slide's next.
Actually, it's just the Q&A.
Q&A. So and next week, just so you know, we're going to talk about lowering your taxable income. So remember, it's not how much money you earn, it's how much money you keep, right? At the end of the day, that's the most important part. So that's a lot of the power of real estate. So I think we're done on the share if you want to just put it out for everybody. Yeah. So somebody has got to have a question. Raise your hand, unmute yourself, put it in the chat. You all look shell-shocked. You look like you didn't put your seatbelts on. Anybody? Is it just too much? Come on.
Hey, Schreier,
I have a question.
Yes.
Oh, yes. By the way, Liz is one of the famous ladies we talked about earlier. So she was up, man, best-selling author now, absolute rock star. So
thank you, Trevor. Appreciate that.
My new best friend.
I think someone else was speaking up for a second there.
Yeah, I was going to ask if you guys invest in land in like Fort Bend County.
Yes. Our R1 Realty One partners, we office from Brookshire area, and we are actively looking for lands. We have 5 acres under contract there, and we finished 2 projects there. Yes, if it is there, we'll take a look at it.
So how would I submit land to you guys?
If you go to massive.capital, there's a form, you can fill that out, that comes, or deals@massive.capital. So deal with S, I'm at deals@massive.capital. If you shoot an email, that goes to our acquisition team. Then we get copies of the email as well. So we'll take a look at it, and then we'll get back with you within 40 hours.
There's also a link if you go to massive.capital/access. It's in the chat, and that'll take you to a place to submit a deal.
Thank you very much.
Nick asked, what is zombie assets? Zombie assets just literally like zombie. It doesn't respond to anything that you do. So sometimes you buy those assets, it doesn't matter. You can do a facelift, you can do an interior lift, whatever it is, the revenue will stay more or less the same. And those are the zombie assets. You can't, the price is so high, and you're so deep, so we paid so high for the price, there's nothing we can do to catch up on the revenue side of it, to increase the NOI, to get any profit out of it. Those are the assets. So, to think about last 5 years, market just took a turn. For same NOI, if my NOI was $100, it would have been a 6 cap 3 years ago, 5 cap 2 years ago, 4 cap, 4.5 cap a year and a half ago. It didn't make money, but I still got paid. Those are the zombie assets. They're quite a bit of those.
So Liz had a question.
Yeah, I haven't heard the term bolt-on acquisition. Can you go into that a little bit, Shar?
Yes, so sorry for everybody else. I come from the M&A. I did a little bit more M&A work for Shell. So bolt-on means you have an existing asset and you're bolting onto it. That means when we say bolt-on is if you own an asset hypothetically in Austin in a certain location, a zip code ABC. So if any asset shows up close to that location, it's a bolt-on. You're bolting on to something. That's what.
Got it. Thank you.
John had a question. Are you incorporating an OZ precedent? Definitely no. The why? Because we like the concept of the OZ, but we don't like the concept of the longevity of holding an asset. The asset becomes very inflexible when you own it. We like to have options to exit, and so if the market turns, we'll turn with the market. Those optionality matters for us. Another thing that that was the primary reason that the exit time is way too long. And the second one is that most of the OZs are, almost all the OZs are new development. So we didn't have the construction capability back then when those started. And the third one is the most of the OZ profitability will happen for two good reasons. One, some big company came in, went to identify an area to do a big block. So that means if you look at Houston, there's about two different places there. It's worth doing a large scale OZ projects because they're closer to downtown, heavily being gentrified. Rest of the area, there's no front. So when they put together that longevity, not having option to exit, it's a big chunk of change when you do each of the projects, and very handful of places you can populate those class A new development. It just didn't make sense for us to do it.
And one thing on land too, we're not looking for land in the middle of nowhere, correct? We're looking for land on definitely urban growth paths, right? That Georgetown, the 10 acres we bought with the land acquisition. I live in Austin. It's like 20 minutes from my house, and it's where the world is going, right? So we're trying to buy land where the world is going, kind of before everybody wakes up and realizes it's going there. It's not always easy to do, and there are a lot of people that have made a lot of money, because they don't make dirt anymore. It's just there. But we like to go in areas that have, on the path of development.
I can talk a little bit, right? We look at every single projects, three different buckets. First bucket is raw land development on paper. Second bucket is doing the construction, and third bucket is the operations. So each of the bucket, if you think about 3-year cycle. So someone would buy a land today, they have to go through the entitlement process. It takes 2 to 3 years ish. And then you go to construction and another 2 to 3 years, and then you get into the operations, right? So that's how we kind of bucket that out. And buying the land is the most riskiest because you're exposed to almost everything, right? You're exposed to the entitlement risk, you're exposed to the construction risk, you're exposed to operational risk. And if any one of those two market changes, you are stuck with it. So that's one, which is why our decision hierarchy is the land. We are taking a looking at it. We have some core assets we already know. Between the Realty One and us, we have done over 35, 40 projects in Houston, San Antonio, Houston, Dallas, Austin, San Antonio area. So we have a good understanding where is the revenue would come from, and we can get to a really quick decision whether that's land is worth pursuing or not. Good question, very good question.
Awesome. Do you got another question, Liz, or you just want to keep your hand up because you're a big rock star now?
Sorry about that.
No, don't be sorry.
Good. This is great. Thanks, guys.
It's good to see so many familiar faces here. Thank you so much for coming every week. We hope our goal is right to answer your questions, provide value, provide our points of view. We don't always have 3 shameless plugs, so
That was a special day.
I like promoting stuff. I like, and it's all good stuff. Oh, my new friend Pabla, she's here. Good to see you. She just joined up with our mentorship program. They're excited to have her there. And we had a nice call today. And she's going to be hanging out with our rock star ladies at Grant Cardone's 10X. It's a 10X ladies conference. And
So
so
this weekend, right?
Yes,
Yeah.
this weekend, yes.
Nice. And you guys have fun. I saw the audience and also the speakers, those are big ones.
yeah,
Nice. So, as you guys come up with questions, I want to share my oops and aha, oh crap moment, right? So we have two deals right now in Conroe, two retail buildings. Gen 1, there was nothing built after 2019, I believe. We like the location, we bought the land, went through the entitlement process. We got loans, good terms. And one of the lending partners knew, and so both the lending partners are new. One gave us a good one, and we won with both. So yesterday, they call us, loans almost done, everything's been finalized. They go, you know what? We need 15% of the loan amount. It has a deposit in a checking account. I mean, inherently, they're asking for 50% down payment upfront. They're that kind of a risk averse. They want the larger banks and things like that. Then it's a tough ask, right? There's 15% on a $3 million deal. They can for almost $500,000, and they're saying, okay, put your 25%, 30% down. Then on top of that, put another 15%. Otherwise, no loan. And we are going right. So yesterday and today we scrambled through and said, okay, well, let's go figure it out. Then we figured it out today. Okay, I was like, okay, fine. I know we have a way to move over some of the transfers that we have into that bank account to do it. It is interesting. All right. And then we talked to another bank today for an office that we're looking at. They go, and he goes, yeah, I can do it. Only 13% interest rate. I was like, you're a bank. I was like, yeah, you're a bank, office is just too risky. It is interesting times for sure. But it's, deals are happening, right?
awesome.
Yeah.
Any other questions? Well, we can't just keep asking Liz questions. And I can never tell if it's Peric or Rochelle. If it's Rochelle, she's one of my favorites. I got a lot of favorites, if you can't tell.
You're like a kid in a candy store. That's my favorite. Can I get a high five? He's gonna go in that way.
Awesome.
Hey, sure.
Hey,
One more thing, because
Yeah.
I always ask about interest rates and timelines. Seems like you have a better grasp on how things are going and the timelines on everything than I do. So you think one more bump, one more hike, and then we'll stay at that level for at least, you're thinking 12 months, 24 months until the true pain has hit the market, and then maybe some relief. Is that what you're thinking?
that's what the number tells us. That's not. I think I'm looking at it. So it's like I don't know diddly squad, right? But I'm going to stick around with what the bigger players say. How we're going to size the market, right? Who am I to tell which way the market goes? But everybody has their own hypothesis. So I bias mine based on some of the data that we. So I follow something called CME Fed Watch tool. They're really cool. As of today, they have been right. So that's all I can say. There is a tool that's called probabilistic view, and I'll make it bigger for everybody. So what they do, they look at each of those the meetings coming up for the Feds, and they give you a pricing. So what they do, they look at your equity market and say, how is the market behaving? What is the expectation from the market? Because think about it. I'll go back a little bit more academic. So we two concepts. One is the efficient market theory. That means when we buy a stock, the price should be at par with the future earnings. Because if I believe the company is going to make more money, then at least you'll buy it. I'll buy it. Supply, demand, price will be right. Right. So in this case, market is pricing in as of now an 80% chance of going out and rate going up one more time. But then can you look at this? This is what freaks me out, right? Hopefully the job market, something happens. Then we have the November one, they have a 70% chance. So whatever it is, I may be okay. So looking at all those three events, they're saying, okay, I have a 60%, 50% chance in January, then 60%, 70%, 80% chance. But what I'm betting on, look at this side of it. There's not much. Look at that 550, which is second bump on November, only 30% chance. If we would get any other indication, I would have done it. Now you look at this, then you look at the script of Powell and also the script of the meeting when all the Fed chair comes in and they say their comments, and then we go back and study each of the Fed chairs and their thinking. So if you have that 3 layers of thinking together, you can kind of say, okay, I think something's gonna go that way. But for us, always saying it's gonna go up at least one more time, and then higher for longer. It's not going anytime soon, unless we go through a hard recession in the next 6 months or so. So that's my bias for it.
Got it. Thank you.
I love this tool. Guys, I've been, when I started using it about a year and a half ago, I was kind of sort of skeptical. I didn't know whether they're right or wrong. So I have it before and after. So I have Excel file, then I go dump it. So far, they have been right. That's all I can tell.
Awesome.
I'll show you
right.
my secret websites here.
So we're gonna start the after hour early because nobody's got any questions. All that means is any questions. You don't have to be on
Turn off the
top.
video, right?
You don't have to do anything. We can still talk about the topic, but I don't want to keep begging people for questions. Get so many attentive looking people.